Hello and welcome to our monthly global forecast. I'm Corley Zacchino, and joining me today is Alistair Ross. Alistair, last month there were concerns that the US Federal Reserve might start withdrawing its extraordinary monetary loosening of recent years. Is this still a concern?
Yeah, markets reacted with a little bit of panic actually when the Fed first suggested that it may start to draw in its quantitative easing program. I think things have calmed down a little as the nuances of the message have sort of trickled through into the markets. This isn't a withdrawal of QE, and it's certainly not presaging any increase in official policy rates by the Fed. What it is an adjustment in the rate of flow of funds out into the US economy at some point over the coming months. That was what the Fed intended to message to the markets. That is now getting through, and I think things have calmed down to a great extent. The fact of the matter is that the US economy is doing really quite well, considering where we were a couple of years ago at least. The unemployment rate is being eroded now by the creation of jobs. The job creation is running at around 200,000 a month, which is enough to start to make inroads into the US's very high unemployment rate. The economy is improving, growth is picking up little by little, and of course the unemployment rate is particularly important because that is the criteria on which quantitative easing is judged. So when there's signs of unemployment coming down, it's appropriate and reasonable and within its plans that the Fed starts to consider drawing that back in. I think an important aspect here is that although things look reasonably bright for the US economy, signals of a tightening of monetary policy do drive asset allocation all over the world. Quantitative easing has been good news for high-risk assets in emerging markets, in commodities and the like. So the contrary is also true, that when there's some anticipation of QE being withdrawn or monetary policy tightening a little, financial investors start to look back to the rich countries for slightly higher rewards, and there are flows of money out of those riskier assets, which could cause problems for them later on.
We were also pointing out the danger of slowing growth in China. How are things looking now for the second big motor of global growth?
It seems clear that the Chinese authorities are now a little concerned about the extent of the slowdown in China. Some slowdown was expected and indeed required given the unsustainable pace of growth that China had been exhibiting over recent years. But this administration had targeted about 7.5% growth for the year, and I think the economy was beginning to settle towards a trend below that. So they've just announced a bunch of measures, which is like a mini stimulus package aimed at just lifting that growth rate a little. I think it's quite interesting actually what they've announced. So there are three main measures. One of them is tax breaks for small businesses. One of them is some improvement in the administrative red tape, if you like, for exporters. And the other one is some injection of financing for railway construction. Interestingly, only one of those is about an injection of funds into infrastructure, which is the way stimulus has tended to work previously in China. And even that one is quite limited. It's focused specifically on the railway sector. That's partly because there really just isn't the capacity in the Chinese economy to take the kinds of massive injections of funds into broad infrastructure projects that they've used in the past. There's already idle capacity out there. There are already projects that are probably not going to deliver. So there just wasn't the room for that kind of injection. But I think it's interesting that the other two are very much on the supply side of the economy, and they're very much aimed towards easing conditions for private business, which is something of a shift in direction. You contrast that, for example, with the ban on the building of new administrative buildings announced by Xi Jinping just a few days before this stimulus, which goes towards the campaign against ostentation and perceived corruption in official circles. This is a very different kind of set of measures that appears to open the way for more private enterprise and more private business. That's an interesting shift, I think, and possibly a signal of intent under this new administration.
The Eurozone, of course, seems to be an area of permanent concern. What is our current view?
Yeah, the Eurozone still looks very poorly, I'm afraid. I mean, we're now into 6 consecutive quarters of decline on an aggregate basis, which is not great. And also we're beginning to see some of the stronger economies in Europe, the powerhouse, Germany and France, showing some serious signs for concern as well on the economic front. That said, things do look a little better in the peripherals. I mean, the promise of unlimited backing from the European Central Bank last year has really settled things down, and I think it's given those peripheral governments and also the Eurozone itself as a whole some breathing space to try and get ahead of the curve. And I think in the case, for example, of Portugal, Spain, and Ireland, things do look a little less concerning than they were. Of course, the immediate circumstances are pretty horrific in those countries. I mean, 57% youth unemployment in Spain is fairly disastrous for a lot of households. But in the macroeconomic sense, Spain looks as if you can now see a pathway through towards a more stable environment in Spain, and possibly the ability to service its liabilities without having to go back and ask for more help from Europe. And that's a positive. Greece maybe is a slightly different case. I think most people recognise that Greece can't meet its obligations as they stand at the moment under current circumstances, no matter what it does. So that Greece is a bit of a case apart, but I think it's interesting to note as well that markets have begun to distinguish now between the case of Greece and the case of the other peripherals, and there's more of a chance now that Greece could continue to go through turmoil without that having a contagion effect in the rest of Europe. Not good for Greece, but pretty good for the rest of Europe, I guess. Overall, we think that growth is going to come back at an aggregate level. Next year, we're looking at growth of around 0.6% on aggregate for Europe. And that's a lot better than we have seen. It will come as a relief, I think, to the world as a whole to see Europe beginning to get back onto its feet. Worth pointing out again that, underlying all of this, there's an understanding that there has to be some deep structural change if Europe is to survive in the longer term, and we still don't really see any great progress on that. That may change after the German elections, which are coming up. There's no guarantee that it will, but that's the next time that we should stop and take a look and assess how the deeper structural reforms are doing.
Japan's Liberal Democratic Party has just won an important electoral victory, taking control of the powerful upper chamber. What does this say about the prospects for the Japanese economy?
Yeah, it's good news in as much as it begins to give the Prime Minister Shinzo Abe a freer hand in setting out his policy platform. We've been talking about Abenomics, this program of reforms aimed at lifting the Japanese economy out of its 2-decade funk, and this is certainly going to help. 2 prongs of that campaign were on the monetary policy side, where the central bank has been supportive in easing monetary policy, and on the fiscal policy side, where the government has made some moves. In order for this to stick, a lot depends on bringing in deeper structural reforms, which are going to start to reshape the way the Japanese economy works. And having a majority in both houses, that can't hurt. I think it's worth being a little cautious because the LDP is a fairly diverse group of people. They've been brought together partly, as is always the case, by the need to win out against a credible opposition. And now that need is gone, it's 3 years before they face the electorate again. They don't have any real opposition. They've got majorities in both houses. Some of those tensions that exist within the party could start to surface, and that could hinder some of the quite difficult policy decisions that have to be made. But we see the current boost that the Japanese economy has received continuing for a couple of years at least, up to 1.7% or so this year and above 2% next year. And considering that, while Japan has been rising, while China has been rising, Japan has been pretty much stalled. Having Japan back on the world stage as a contributor to global growth will be positive. I have to say, beyond 2 or 3 years, we do see the growth rate settling back to around 1%, just over 1%, so maybe less positive in the longer term. But for the moment, it's good news for Japan, I think, and good news for the global economy.
The China forecast is unchanged from last month. However, you've downgraded India. Why is that?
India was already a little lackluster compared to what we had been seeing in recent years and what we've been expecting. And it's now been further hit by the reallocation of financial resources that we were talking about before with the anticipated withdrawal of QE in the rich countries. The rupee has been one of the currencies that's suffered. India's is a relatively closed economy, so it doesn't get a huge boost from the export sector when there's a declining currency. On the other hand, it relies very much on imports, and that's going to be a headwind on economic growth at higher costs from abroad. Even so, India, we expect it to grow at around 6% for the next couple of years. And that's not to be sneezed at in a country of that size, an economy of that size. So we've downgraded a little, but it's not altogether bad news.
We are now into the second half of 2013, so for many the focus is now shifting to the forecast for 2014. At this early stage, how do we see next year playing out?
2014 is in many ways what we were expecting at the end of 2013, I think. There are nuances and there are differences, but actually what we're looking at is a recovery train that's been delayed rather than cancelled, and we now expect it to arrive at the station sometime over the course of next year. And we've already mentioned that the US economy is beginning to lift and the growth rates are getting more positive and more signs of more sustainable growth there in the labour market, for example, and in the housing market. China has slowed, but we've seen this mini stimulus being announced, and I think that tells you that they're willing to allow the economy to slow to a degree. We all expect the economy to slow to some extent, but they will put a floor under it, and they'll keep the economy ticking over around that 7%, 7.5% rate, which is generally good news for the global economy. We've looked at Europe, where we think this year tough, continuing in recession, but next year on aggregate at least beginning to come out, and maybe some of those peripherals, although they're still going to be problem areas domestically speaking, on the global stage they'll be less of a concern. So Europe in general, we think next year a more positive sentiment and a more positive picture in general. Japan, Abenomics driving the economy forward, and that's going to support the global economy as well. So in general, I think next year looks like a better year. After 2013, which has basically been 2012 all over again, 2014 should be a little better, I think, more encouraging for all of us. And we think the global growth will be around 2.7% over the course of that year.
Thank you, Alistair. For more in-depth analysis on our global forecast, please visit our website at www.eiu.com. Thank you and goodbye.